It's March 2020 and stock markets are crashing as the world shuts down because of COVID-19. You're watching your investments drop 10%, 20%, 30%, and a voice in your head is screaming, "Get out now. Sell before it gets worse." So you sell and move everything to cash, telling yourself you'll wait for things to calm down and then buy back in at the bottom. Except you never do, because by the time it feels safe again, markets have already bounced back and you've missed it. If this sounds familiar, you're not alone. Trying to time the market, selling at peaks, buying at bottoms, is one of the most tempting things in investing, but it's also one of the most difficult to get right. Because with hindsight, identifying peaks and troughs in markets is easy, but in the thick of it, it's a totally different story. Seeing what's actually happening, predicting what will happen next, and selling or buying at the exact right moment is notoriously difficult. I mean, if it wasn't, we'd all be making a killing from stock markets, wouldn't we? Even professional investors with all their experience, technology, and resources rarely get these exact moments right. But still, in the minds of both beginner and experienced investors, timing the market is seen as the holy grail. But are we sure that this type of thinking is correct? Hi, I'm Gary, and today with Moneyfarm, I want to talk about why timing the market usually fails and why the old investing wisdom of time in the market might actually be the smarter approach. Let's dive in. So first, let's be clear about what we mean by timing the market. Market timing is the strategy of trying to predict when markets will go up and when they'll go down, and then acting on those predictions. So the idea here is that you sell your investments when you think the prices have peaked, stay in cash while markets fall, and buy back in just before they recover. On paper, it sounds brilliant. Avoid the downturns, capture the upswings, and watch your wealth grow faster than everyone else's. The problem, those turning points are only obvious after they've happened. The reason for this is that markets don't move in neat, predictable patterns. They respond to a massive, complicated mix of things such as economic data, political events, interest rate decisions, corporate earnings, and global crises. And they respond fast. So by the time you're reading the news, the market has often already priced it in. But it's not just about information. There's also something called investor sentiment. Basically, how people are feeling. When investors are optimistic, they buy, and when they're nervous, they sell. And sentiment doesn't always match reality. Sometimes markets fall even when the economic news is fine. Other times they rise when everything seems terrible, and that's because they're reacting to future expectations, not just today's headlines. Let's go back to that COVID example from March 2020. At the time, it felt like markets might keep falling indefinitely as the world was in uncharted territory. The mood was grim and a lot of people couldn't stomach it, so they sold their investments and sat on the sidelines. But then, almost unexpectedly, markets bounced back. In that case, like many other cases, the strongest recovery days happened early on, when confidence was still low and the news was still terrible. That means that if you were sitting in cash waiting for the right moment to get back in, you missed those days. And that's the problem with market timing. You have to get it right twice. You need to know when to get out and when to get back in. Even professional investors with all their resources, technology, and experience rarely get this right consistently. So, if timing the market is so difficult, what's the alternative? Well, it's right there in the title: time in the market. This is the idea that staying invested for the long term, riding out the ups and downs, tends to be more effective than jumping in and out trying to catch the perfect moments. Let me show you why with some real numbers. This chart shows what happened to $10,000 invested in the S&P 500 between July 2005 and June 2025. 20 years that included the financial crisis, COVID, and plenty of other bumps along the way. Look at that first bar. If you stayed fully invested the entire time through all the ups and downs, your $10,000 would have grown to $66,737. Not bad, right? Now, look at the second bar. This is what happens if you missed just the 10 best days of those 20 years. Your $10,000 would only be worth $29,690. That's less than half. Miss 20 of the best days, you're down to $17,530. Miss 30 best days, $11,445. And if you missed 60 of the best days, which is only 3 days a year, your $10,000 would actually be worth just $4,121, which means that you'd have actually lost money over 20 years in a market that went up. And here's the thing that makes this even more brutal. 7 of those 10 best days occurred within 2 weeks of the 10 worst days. And the second worst day of 2020, March 12th, when markets were in free fall during COVID, was immediately followed by the second best day of the entire year. So if you were sitting in cash trying to avoid the bad days, you almost certainly missed the best ones too. And in a nutshell, that's the problem with trying to time the market. You're not just trying to predict one thing, you're trying to predict when to get out and when to get back in. And if you get either one wrong, you'll cost yourself decades of returns. So you get the point. Time in the market beats timing the market. But apart from what we already said, there's another reason why this is true. Compounding, which is when the returns you make start making returns of their own, like a snowball rolling downhill, getting bigger as it goes, as we talked about in this video on the channel. But compounding needs time to work its magic, so the longer you stay invested, the more powerful it becomes. That means that if you keep stepping in and out of the market, you disrupt this process. You're essentially stopping the snowball, letting it melt a bit, and then trying to start rolling it again. And then there's also another problem, which is connected to what you do when you sell. When people sell their investments with the plan to buy back later, that money usually ends up sitting in cash. And cash is fine for short-term needs and emergency funds, but it's not great for building long-term wealth. Cash returns are typically linked to interest rates, and over time they often struggle to keep pace with inflation. So while your cash doesn't actually shrink in value, what you can buy with it does. That means that too much time on the sidelines can quietly eat away at your purchasing power. So even if you're not losing money in the traditional sense, you're losing the opportunity for your money to grow. So, time in the market means sticking with it through the ups and downs, keeping your eye on the long-term picture. But how do you actually do that in practice? Because, let's be honest, staying invested when markets are failing is hard. Really hard. Well, here are some key things that can help. 1. Invest money you won't need soon. This is crucial. If you might need your money in the next few years, investing probably isn't the right place for it, because if you need that money during a downturn, you'll be forced to sell at exactly the wrong time, as you won't have the luxury of waiting for markets to recover. To give you a reference, most experts suggest you should be willing to leave your money invested for at least 5 years, as that gives you time to ride out the inevitable bumps. 2. Know your risk tolerance. Different investments come with different levels of volatility, which means that some bounce around a lot more than others. If you can't handle watching your investments go up and down, you might panic and sell at the worst possible moment, which defeats the entire purpose of long-term investing. So, think honestly about how much risk you're comfortable with. It's better to choose investments that let you sleep at night and stay invested rather than chasing higher returns with investments that make you too nervous to stick with the plan. 3. Diversify. Spreading your money across different companies, sectors, regions, and even different types of assets like bonds can help smooth out the ride. So if some of your investments fall, others might hold steady or even grow. To be clear, this doesn't remove risk completely, but it can make it easier to stay the course when things get rocky. And one simple way to diversify is through ETFs or other funds. With just one fund, you can own a small stake in hundreds of companies. With a few funds, you can diversify even more without needing to spend hours researching individual companies or building a complicated portfolio yourself. 4. Consider investing regularly. Instead of investing a lump sum all at once, you can drip feed money into the market over time. This approach, sometimes called pound cost averaging, means you're buying investments as markets go up and down. When markets are high, you get a bit less for your money. When they're low, you get a bit more. This takes the pressure off trying to find the perfect moment to invest, as you're not trying to time anything. You're just consistently putting money to work. And with platforms like Moneyfarm, you can set up automatic monthly payments, so you're investing consistently without even thinking about it. The money just goes in month after month, building up over time. So here's the bottom line. Timing the market is tempting. We all want to dodge the downturns and capture the gains. It feels like the smart thing to do. But in reality, it's incredibly difficult to get it right, even for professionals with armies of analysts and sophisticated technology. Time in the market, on the other hand, is about playing the long game, staying invested, riding out the volatility, and giving your money time to grow. It might not be as exciting as trying to outsmart the market, but as that chart showed us, missing just a handful of the best days can cost you half your potential returns or more. And here's the thing, you don't know when those best days are going to happen. They often come right after the worst days, when everything still feels terrible and your instinct is to stay in cash. So instead of trying to predict the unpredictable, focus on what you can control. Staying invested, diversifying your portfolio, and giving your money time to compound. And that's a wrap. I hope you found this video helpful. If you did, please subscribe to the channel for more guidance on how to invest long term. And be sure to check out the description below, where you'll find more information about Moneyfarm and how it can help you in your investing journey. And as always, see you in the next video. Bye.